to the Hope Finance 101 meeting. It is such a pleasure for us to have this meeting because a lot of people, especially children of God, miss out on a lot of resources financially. We work so hard in our lives, but we don't know how to manage the money that we work for. And so you see people are always busy all the time, trying to make money. And then they work for the money instead of the money working for them. And that is just because of knowledge. And I really like the scripture that Papa put in the group. And I want to also thank you, Papa and Mama, for the privilege to come up here and speak about finance to the church, because it is a very important part of our lives. If we do not know how to manage our finances, we are only going to keep working and thinking that God is not answering our prayers. It is just because we do not understand how finances work. Of course, the Holy Spirit teaches us, but we need that practicality, because when we don't mix our prayers with principles, we will miss out. If we only pray and not apply the principles, then we will miss out. But this is what I'm teaching you today, the principles of money. How you can manage your money in this North America. I know I understand that people are going to be watching this video from all parts of the world, but what I'm saying, it's applicable to everybody as much as, especially for people in Canada and the US. And so, the Bible says in Deuteronomy 8, verse 18, Deuteronomy chapter number 8, the verse number 18, that, but you shall remember the Lord your God, for it is he who gives you power to get wealth. He didn't say that it's he who gives you wealth. He says he gives you the power to get wealth. Therefore, you have to go get the wealth. You have to go get the wealth. He said that he may establish his covenant, which he swore to your fathers as it is this day. God is a covenant keeper. He's a covenant establisher. And when he says it, he will do it. But many a times we feel that he said it, he did not do it. It's just because we're not applying the principle of it. Another scripture that talks about wealth that I'm going to bring us to is Proverbs chapter number 13, verse 22. It says, a good man leaves an inheritance for his children's children. I like this one. It's always my favorite scripture that I quote to the people that I give them financial advice. Because many of us, when we work, we think that we're working the money just to take care of ourselves and leave money for our children. No, there is a way you can leave money for your children's children, for your grandchildren. And I'm going to go through it. I have a lot of things to run through for the time that we have. So if you have questions, just write them down. If we are not able to cover all the questions today, you can always approach me at any time. We can arrange a meeting and all of that, and I can put you through any questions that you might have. Because there is really a lot that I just want to touch about finance, and I hope that some other time we'll get to also come and take it bit by bit. But a good man, a good woman, a good child of God leaves money not only for your children, but your children's children. And it is not late for us to start doing that. Another scripture that I want to touch before I go to the details is Luke chapter 16, verse 8b. It says, for the children of this world are in their generation wiser than the children of light. We are the children of light. The church are the children of light. But they say the children of this world are wiser. Because you see, most of the time, the people that are rich are the children of this world. And you ask, how is it? Because they are applying principles. They are applying principles. They are applying principles. And if you think that I did not introduce myself, I kept that so that I might quote the scriptures first. My name is Adeline, Ijang Adeline, and I am a marketing director. I have worked with the bank for 12 years, and I decided to set up my own brokerage practice. So I am a financial broker by profession. And so I'm going to quickly go into what I have prepared today for each and every one of us. I'm going to start with credit cards, because it is one of the things that if you're not careful, it will drain you and drain you right into the pit of hell. And so credit cards, should you even have one? Of course, if you are in North America is a credit system. So it is advisable that each and every one of us, especially the young ones, if you want to build credit, you must have a credit card. If you do not have a credit card, you go to buy a house, you have no credit. They will check you up. Canada has 2 credit bureaus, legal credit bureaus. TransUnion and Equifax. Now there's also Credit Karma, but there's only two that are illegal. Credit Karma, you can check your credit, you can do that, it's not illegal. But the ones that are recognized when you're doing a mortgage or this is TransUnion and Equifax. And if you do not have their numbers, you can always ask me, because you have the right to check your credit once a year for free. After that, if you check your credit, it will hit your credit bureau, and they might charge you as well for that. But should we have a credit card? Yes, in North America, you should have a credit card, because it is a capitalist system. It is a capitalist system. It means that you can do nothing without credit. And so you should have even $500. And it's called revolving credit. And so that's what we need to understand about revolving credit. It means that your credit card does not have the same due date every month. Some people think that I have to make my payments on the 1st of every month. No, that's not true. You want to look at your statement, your credit statement. It's a revolving credit. It revolves around a circle. So the most important thing when you have a credit card to take note of is your circle date. How does my credit card circles? So if your statement is being printed on the 11th day of the month, it's the 11th business day. Take note, it's the 11th business day or the 10th business day or the 20th business day. It didn't say the 11th day of the month. Many people get confused by that. It means that if it is the 11th day of the month, the 11th business day of the month, you take your calendar, you are excluding weekends. You are excluding weekends, you're counting Monday to Friday. So when you are counting that, you count the day, you know that if this one started with a Friday or Saturday, it means that my credit, my statement will print on the 11th day. You count those 11 days, then it prints. You have 19 days grace period. And you have those 19 days grace period to pay. It means that within 19 days, if you use your credit card, you have 19 days, they will not charge you. But after the 19 days, you will get charged interest. But if you have carried on a balance from the previous statement, then there is really no grace period. So you need to make them at least the minimum payment to keep your credit good. Now, if you have a $1,000 credit card, if you use $500, it means that you're halfway. If you've used the $1,000 or $750, already it sends a message that this person is having financial issues. That's why they're using more of their credit and all of that. But that doesn't report on your credit bureau that you're owing. But when you miss one payment, after 30 days, if you're past due, you don't make your minimum payment. Pay attention to your minimum payment. If you don't have, even you don't have, you put your minimum payment. So when you don't do the minimum payment, then you're past due. And then when you're past due, it hits your credit bureau for 30 days. If you're past due for 60 days, you go from R1 to R2, and you just keep progressing, because the best credit rating is R1. The worst is R9 in Canada. And so when you go from R1, it starts switching. When you go 90 days past due, you are getting complicated right now. After 90 days, that's 3 months that you've not paid your credit card. Or you are carrying that balance, maybe you're making less than the minimum payment. If your minimum payment is $10, if you make $9 if you pay $9 or $9.50, you have not paid. The system does not recognize that payment. It takes it, you're still delivering. So pay attention to your minimum payments. If your minimum payment is $10, make sure you pay it at least $10. If you pay $9, you did not pay, you will still be past due. And so when you do that 90 days, you get a demand letter. The banks will send you a demand letter, which is telling you that if it is not paid, they're going to close the card, because at that time you're already in danger. Your credit score is getting really real. When you go like 120 days, the bank can close the credit card. They have the right to close that credit card at that time. And your credit is getting worse and worse when you get to the collection agencies. When they start having collection agencies calling you, that time you're really, really ruining your credit. Now, it is on individual basis. So that we have to review your statement to tell you what rating you have. But if you check your credit bureau, you see the rating that you have. So what is my point here? Pay attention to your credit card bills always. What is the minimum payment? What is the due date? If you have a credit card, say, with Royal Bank, and your bank account is with TD or another bank, if you know that if your due date is the 10th on your statement, make sure you make that payment around the 7th or the 6th. Because if you pay on that 10th, unless you go into that bank that has the credit card and pay, if you pay, there is a 3 days, because it's interbank transaction, so you will be late. Those are some of the things you need to know about that. For more about that, you can reach out to me, and I will show you more, especially when I look at your credit, your bank statement or your credit card statement. I can tell you more. And then about bank accounts, I'm just going to run through that one. Bank accounts, should we have a joint account or sole account? Many families, many couples run into trouble with bank accounts. joint or sole. Everybody's not a one size fits all. You know what works for you. There are families that joint account works for them. There are families that sole account works for them. So you need, as an individual, to know what works for you. You need to. I cannot tell you that, oh, joint account is good or sole account is good. There are situations in which joint accounts are good, in the sense that if the other person passes away, the other person can take over that account. They can own that account. But as well, there are conditions to that, to those joint accounts, that when you're opening those joint accounts, you have to know, because you can have a joint bank account, you have 100,000 inside, that other person has a credit card on their name, and they owe a debt on it. If there is no right of survivorship, if that person passes away, they will take, the bank has the right to take money from that account and pay out the credit card. Even though it's joint, whether it is your money or not, it doesn't matter. They will still take and pay the debt. So those things you have to know when you have a joint account, when you are having a joint account. When the joint account that I have, do we have a right of survivorship? Which means that other person passes away, I can own that account whole, 100%. Everything passes over to me, or the account could be shared 50-50. They will say 50% of the funds that are in that account belongs to the estate of that person that passed away. So those are things that you need to know about joint accounts. For sole accounts, of course, once you pass away or something happens to you, that account is frozen, and then your estate administrator takes over from there, and we go from there. I'll talk about estate very soon towards the end of that. The next thing that I want to talk about real quick is mortgages. Mortgages. For those who plan to buy a house or you already have a house, are you making monthly payments or semi-monthly payments or bi-weekly payments or weekly payments? There is a difference in that. Pay attention, there is a difference in that. If you're making monthly payments, you are not paying your mortgage faster. If you're making semi-monthly, still good, but not the best, because you're paying just twice a month. Now, bi-weekly is different from semi-monthly. Semi-monthly means you're paying on the 1st and the 15th of the month. But bi-weekly means every 2 weeks. So in a year, if you're doing bi-weekly payments, you are doing 26 payments in a year. So you are additional 2 payments. As opposed to if you were doing monthly payments, there will be just 12 payments. If you break them into semi-monthly, it's still the same. But bi-weekly is good because you are paying down faster. Now, weekly is even the best because you're paying every week, and we have 52 weeks. If you add it up, you compare with what you're paying monthly, you will see that you're paying down your mortgage faster. Now, for those that are buying homes, about the down payment, is it 5% or 20%? Which one is the best? It all depends on you. If you're a first-time home buyer and you have 5% for your down payment, that is good. It is good enough. Even if you have the 20%, you can actually choose to put the 15% in an investment house and only do the 5%. But if you're a second-time home buyer, you have to have the 20%. So that doesn't even apply to you. If you're buying a home for the second time, you need your 20%. But if you're a first-time home buyer, down payment of 5% is good. So if you even have more than the 5%, you have 20%, you can actually invest the 15% in an investment house that will give you more that you can take it out later and pay out your mortgage. Now that I would need to use the compound interest calculator, which we cannot do because of the internet connections in Canada today. So I would have loved to show you right online and show you how it compounds, and then you see the difference. But yes, if you're a first-time home buyer and you have your 20% down payment, and you want to know what to do, should I put this 20 or should I just do 5%? You can always reach out to me for advice, and I would illustrate it for you and you see the difference. But if you're a second-time home buyer, of course, automatic, you have to have the 20% down payment. Now, when you have a mortgage, the banks ask you, do you have creditor insurance? Do you have insurance? So there is what they call creditor insurance. Now, I would advise everybody that is buying a house, when you're buying a house, it is good that you have your life insurance. If you have a life insurance, then you don't need a creditor insurance. Because creditor insurance is a decreasing amount. Creditor insurance is you insuring that mortgage, that if you die, the insurance will pay out the balance of the mortgage. Now, if you take creditor insurance, let's say you're paying $250 a month for the creditor insurance. If you bought that house for $500,000, even after 5 years, that balance has gone down to maybe $400,000. You will still be paying the same amount of creditor insurance that you were paying from the beginning, even though the balance of the house has decreased. And if you pass away, the insurance is paying the bank, not you, even though you were the one paying the insurance. They're paying the bank, and so they will just pay out the mortgage for you. So the best thing, instead of you taking a creditor insurance for the amount of the mortgage. They say the house is 500,000. Why don't you take a life insurance that is 500,000 that you pay that amount until you pass away, or whether you're doing term insurance for 25 years, I'll get to insurance, and then I'll tell you the different types of insurance as well. But that can help, because once the bank asks you, you say, I have a life insurance, they can ask you how much is your coverage. They will not bother you about the creditor insurance anymore. And another thing you have to know about creditor insurance is that they do post-claim underwriting. It means that they can do the insurance for you, and then when you pass away, that's when they begin to underwrite. They'll go deep what caused the death and all of that. And then they see that there were some conditions that were not stated, were not declared before the insurance, they will not pay. So you just pay the insurance in vain. But when you're doing your life insurance, they go through that underwriting right up front. So that is the difference when you are doing a mortgage. So take note of that when you're buying a property. And then the next thing I'm going to talk about is loans. For car loans, let me start with car loans. Should I buy a used car or should I buy a brand new car? It is up to you. Some people think that just buying a brand new car is good. It is good as well, especially if you're getting those 0 down payment, 0% or 0% interest rate. The truth is that the 0% interest rate, it's another ball game, which I can discuss with you. You will see how the interest is being factored into the car before they give you, and it's 0%. But again, should I buy a new one or a used one is what I want to touch here, depending on the interest rate. The truth is that if you're buying a new one, there's no 0%. Most of the time, there's no 0% interest. But a used car, the thing is that if you get a used car that is like a year or two, or only a year, or even 6 months old, say it's a Mercedes. A Mercedes, you might see a brand new one, the same car, 2018 Mercedes or 2022 Mercedes car. They say the price is for 120,000. And then you see the one that has just been repossessed from somebody that took it and could not pay. Maybe it has mileage of 20,000 kilometers or 10,000 kilometers. You will see that it's the same 2022, but it will not be that 120,000. The price has gone down to 100,000 or maybe even 80,000. So if you get that one, you're saving like 40,000. So if you were getting a brand new, you would never save that on interest rate, even if it's 0%. So you have to be wise when you're buying a car. Those are things you take note when you're buying a car. Most of the time, it's good to buy a used car. And it's good to buy a used car. Look for a car that's 1 year, 2 years old or something. The discount that you get from the difference of a brand new car, it is huge. It is huge. I learned it the hard way. But those are facts. A bank loan or a line of credit. Now, if you want, because you can walk to a bank and ask for a loan. You can go to the bank and ask for a loan. What do you want to do with it? I want to pay my debts. I want to consolidate my debts. Or I want to pay my car. Instead of a car loan, you just get a loan that I owe the bank this amount of money. Now, you want to watch for the interest rates on that. Most of the time, lines of credit have a lower interest rate. So you want to look at the line of credit as well. So instead of just getting a bank loan, also look at the option of a line of credit. You qualify for those things anyway. But you look at the interest rates before you go for either a bank loan or a line of credit. And the lines of credit are good because you pay the minimum. You pay the minimum and you follow. It's a revolving credit, just like the credit card as well. But lines of credit are really, really good. But the bank loans too are good depending on what interest rate they're giving you. You want to watch here the difference between a bank loan and a line of credit is the interest rate. So if the other one, the interest rate is cheaper, say for the bank loan, then that's good. But they'll put you on a fixed amount. That is the difference between a bank loan and a line of credit. Because a bank loan, if they say you're paying $100 every month, you pay $100 every month. Line of credit, you go with the minimum payment. The next thing about loans, student loans or RESPs. Now, if you are in Canada, you have kids, and you're like, I don't care about investing for them or opening an RESP for them. RESP is Registered Education Service Start. You say, oh, they'll grow up and take OSAP. Guess what? The best thing for you to do is actually get an RESP for that child. For each child, as the child is born, get them an RESP. The government of Canada gives money for RESP. I'll touch on RESPs very soon. But for students, rather than getting a student loan, do an RESP. By the time they reach 18, that money is available for them to use and go to school. I will explain RESPs later. For those that already have student loans, you want to get them paid because they also affect your borrowing. If you miss a payment, it affects your borrowing capacity. If you go to do a mortgage, they take into consideration your student loans. Some people think that, oh, because the interest rate is cheap, I'll just pay anything. I'll just pay maybe $50 after all. But you want to take a look at it because it will affect your borrowing when you want to get a mortgage or get a house. They see that, oh, you have a student loan. So don't just relax on it and say, oh, the interest rate is very low, so I don't care about paying it as fast as possible. Now, I know I'm going too fast, but again, if you have your questions, please put them down. And then when we finish, we can go through the questions. Okay, now investments, building wealth. This is one of my favorite topics. In Canada, there is RRSP, so Registered Retirement Savings Plan. In the US, it's called 401k. So it's the same thing, 401k, RRSP. And the best thing about RRSP is the tax deduction part of it, because you are deferring the taxes to pay them later. So it's a tool that you want to take advantage of. If you do not have an RRSP and you're saving for your retirement, you think you're putting the money in your bank account, you're not doing yourself good, put it there, because any money you put there, you get a tax receipt for that. Some people just think because we have the RRSP contribution at work, that is enough. No. Each person needs to, from your salary, your take-home income, have an RRSP aside. You could be putting $50, you could be putting $100 according to your capacity. These are investment houses to take care of. Imagine that you're putting $50 every month. Excuse me. If you're putting aside $50 every month or $100 a year, that's $1,200. You're going to get a tax receipt for that. Or you are putting $50 is $600. You get a tax receipt. And that, at the end of the day, you still get a tax write-off for that to claim your taxes with. But you are putting it where you put that investment is another thing. But let me take each and every investment house, and then I'll tell you how you can invest that. And then the next form of investment that you can do, the good thing about RRSP is that you get income tax deduction from it. Now, there is the tax-free savings account. The tax-free savings account is one of the things that is highly misunderstood in Canada. I've had meetings with so many people, including people that are born in Canada, including white people. So do not think that's only amongst us, the Africans, but it includes everyone. Tax-free savings account, people ask that, oh, it's my money, and the money taxes have already been taken. So why is it called tax-free savings account? The reason why it is called tax-free savings account is because when you put money in that savings account, thank you so much, Joyce. When you put money in that account, any profit or interest that you make from it is tax-free. That's why the government of Canada says you can only put $6,000 a year. So if from the beginning you've been in Canada since the time that the tax-free started, I think it's 2009 or 2000 or something like that, it's about 81,000. If you calculate, if you were here since 2009, I think it's 6,000 a year. So if you calculate it back, it's about 81,000 to 87,000. If you have not put it, you have the right to still put that amount of money into the tax-free savings account. Now, you can only benefit from a tax-free savings account. If you just open a tax-free savings account that is not an investment account, you will not benefit because you don't see any interest on it. Many of you agree with me because I did when I was working with the bank. I had a tax-free savings account, but I would go there, my money is the same. I'm like, so what's the big deal of this account? There's no interest that is coming to it. Or sometimes you go there, maybe you had $1,000, you come 50 cents added. So is this all and all of that? No, it's because you do not know how to invest that money. That is true. And so with it grows, no taxes on the growth. So if you put 10,000 in that account and you invest it well, you come next year, it's 12,000. Your 2,000, you take it tax-free. That's what it means by tax-free savings account. So the profit that you make from that account is tax-free. So if you put that 81,000 in that account, I have a customer that has maxed out their tax-free savings account with that amount of money in it. So that you make money from it. There are people that have 81,000 or 80, 70,000 in it. At the end of the month, even though the markets are down now, but when the markets are really good, sometimes at the end of the year, those people have made about 20,000 on a tax-free savings account. On the tax-free savings account, and they take it to go on vacation. So you see people just going on vacation, enjoying that. You're like, how are these people? We work the same work and this. But people put their money to work for them because they take advantage of RRSP and tax-free savings account. There is another one called RESP. Now, I'll deal with how you can invest this money. RESP, the one that I talked about, Registered Education Savings Plan. Now, if you have a child that you give birth to your child, you open an RESP for them, you get up to 7,200 for the 18 years that you're contributing into that plan. If you are contributing at least from the time that the child is born, you're contributing about $183 or $85 every month for that child. You'll get that. And the government gives you the Canada Learning Board $2,000. Now they can put it right up front as you open the account and start contributing, or sometimes we'll just put $500 in it, and then subsequently they increase it. They call it the Canada Learning Board from the government. So in effect, you get about 7,200 or 9,000 from the government when you have an RESP. Why won't you take advantage over 18 years, and then you are still also making profit if you invest it well, if you put it in the right investment house. So every parent needs to have it for their children. And it's not late so far as the child is not 18. You put it and you contribute. The more, if you contribute more than the amount that the government matches, they will only match to their allowable amount, because the maximum you can get is 7,200. So they will match up to 7,200. So put it. Some people come, maybe the child is already 9 years, 10 years, they did not put anything, they open the account, and then we go back and calculate and see how much can you contribute in order to benefit from this amount from the government. So people are putting $500 inside. So there is another one called LIRA. LIRA is locked in retirement account. Locked in means that, you know how you change jobs, you work from one job to the other, from one job to the other, and then you leave from there, your pension money or your RSPs, your pension money is left at that job site. But by the time you left that job and went to another job, maybe you had 5,000 and you left the 5,000 there, that money is going to stay there at 5,000 till the time that you retire to take it. And so instead of you leaving it there, you can take that money out and invest it in an account called LIRA, which is a locked-in retirement account. You put it in there and it begins to generate profit for you. It's locked in, you can only take it at retirement because it's your pension. It's your pension that is being kept at work. So if you have changed jobs and you've not collected your pension, then you want to go back and think about that and collect your pension and put it in a LIRA account. Because sometimes you might even be old, you don't remember the company that you worked for 20, 30 years ago. So do not leave your money behind. Do not leave your money behind. I had a pension account when I left Denmark. When I was studying there, I came here. I had to write to them to release my money for me. So you can do that, but they will release in Canada. If you move from one job to the other, you have that pension. You have to produce a LIRA account because it's retirement money. So they will not give it to you cash. So you have to provide a locked-in retirement account. That's what LIRA is. And they put the money there, and it begins to generate some money for you. And then there is the RDSP, which is the Registered Disability Savings Plan. This is for children. Registered Disability Savings Plan. This one, if you have a child that has a disability, you know, most of our kids, when they are born and they're slow in things, they say, oh, this one is autistic, this one is this one has this disability. These are accounts that is good to take advantage of. Because this one, the government matches up to about 300% of what you're putting in. So why won't you take advantage? If your child has been branded with a disability, you can open this one. It's only for children that have disabilities. So if your child doesn't have a disability, any disability, then you cannot have the Registered Disability Savings Plan. So those are vehicles that you can take advantage of. So you can always write them down and come back to me with your questions, and then we can go into them detailing. Because this is like Finance 101 that we're doing. So I'm giving just the basics of what they need to know things. And so if there is something that speaks to you that you want to get details about, then we can go into the details. Now, I'm going to go to the insurance part to protect your family. Many of us leave our destinies to chance, which is not good. In Canada, you can be rest assured that if you are paying for insurance, if they approve you for an insurance, there's definite high chances that there will be a payout. There will be a payout. Unless there was something that you did that you lied when they were writing during the underwriting process. But if you've been approved and you're paying your premiums, keeping your premiums, there's always a chance that there's going to be a payout for it. So why don't you take advantage and secure and protect your family with a life insurance? There's so many of us, it saddens my heart when people die, we go to GoFundMe. It's such a pity for me. And many of us, At least in our Cameroonian community, we have what we call Retio Pays Natal, which is the program that you can, we do it communally for funerals. But that is not enough. That is not enough what you get from there. You see, many people that are working, they don't get a life insurance because they think that I have coverage at work. How much is the coverage at work? The group insurance at work, how much is it? And bear in mind that you only get the group insurance as much as you're working there. So if you move from that work, or if you work there till you retire, once you're retired, you don't have any insurance anymore. Because the insurance only covers you as long as you're working at that job. So why would you live your life that way? Because most of the times, you might only pass away after retirement. So you don't leave it to group insurance at work. It's great, but what happens after retirement for group insurance at work? Group insurance at work, first of all, most of the time, they will pay you your 1 year salary. So if you are making 50,000 a month, that's what you get. Some companies might double. That's the highest they could go. Say if you're making 50,000, they'll do your 2 year salary. So if you're making 50,000, they give 100,000, which is good. That is if you die when you're still working. That is the work of the group insurance. So why would you live your life to that kind of chance? It's better for you, besides that, to get an insurance for yourself. Now, there are different kinds of insurance that you can take. There is term insurance. I'll start with term insurance. Great, term insurance is good, especially for starters. Excuse me. Especially for starters, term insurance is good. If you are maybe a student or doing something and your source of income is still low and you cannot afford a universal life or a whole life insurance, start with a term insurance. You can start with a term insurance or combination insurance. Term insurance is very cheap, but you take it just for specific time. So you can take a term insurance for 10 years, for 20 years, for 25 years, 35 years, or more. And you pay for those number of years. But what happens when that one is done? If, let's say you take it for 20 years and you're 30 years, you're 50, that insurance is done. If you have to go take another term insurance at age 50, it's going to be very, very high, and they're not going to cover beyond 70. I think it's 72 is the maximum age that they cover. So that is good if you are working and you're struggling with your finances. At least get a term insurance because it's cheap. You could get a term insurance $50 or low. I have a client that has a term insurance for like $28 she pays because she's very young, because she's still going to school. Once she starts working, you can actually convert the term insurance into a permanent insurance, or you can take a combination, permanent and term, and then begin to convert it the way it works for you. Now that is the first form of insurance that you can take, which is cheaper. The second form of insurance is permanent insurance, which is a universal life and whole life insurance. This is great for estate protection and tax-free wealth as well. And term insurance too is tax-free wealth. And estate protection, for this one is good for estate protection because it covers you all your life. Now for universal life, you can actually take a universal life policy that you pay only for 20 years but you're covered for life. Or you pay only for 25 years but you have the coverage throughout the rest of your life. So you stop paying maybe after 25 years, but you're covered for the rest of your life. And on the other hand, the universal life policy has a cash surrender value. So for some greedy people or people that don't want to waste money, for one, I don't like to waste money because I feel like if I'm putting my money in a term insurance, I'm flushing it because you pay that and you don't get anything back. You can take a universal life insurance because the money that you're putting there is also an investment. So you would end up, if at all, at any point you don't want the insurance, you surrender the policy and you take your money. Every money, you will recover everything that you put inside. That's another good part of the universal life insurance and the whole life insurance as well. That if you have any more questions about those, the whole life and the universal life policy, you can reach me. Those ones are also good because you are creating wealth. That's another place where they say a good person leaves wealth for their children's children. Because if you take that policy or universal life for your kids when they're young, there is a compounding effect to the money because there's an investment component. So it's 2-in-1, investment plus insurance. So the money begins to compound. And when it compounds, at the end of it, you might have insured your child for 1 million or 500,000 because they won't even allow you to insure the child for 1 million. Maximum will be 500,000 or 350. By the time they get to like 70, 80, they might have 1 million in that policy or 2 million, depending on the time that they have the policy. At that time, they can change the beneficiaries and put their own children. That's how you leave wealth for your children's children because they change the beneficiary. If you did the policy as the owner for your child, the child gets to 18, you hand over the policy for them. They can go and take money from there, do their wedding. They could do their wedding. They could do their down payment for their house. They could take the cash surrender value because it has a living benefit inside. They could take that and they buy their houses, they do their weddings, they do whatever they could do, and then they can change the beneficiaries and put their own children. That's where you can leave money for your children's children. The policy was bought by my parents, but I benefit from it, my children benefited from it. That's how you leave money for your children's children through this kind of insurance. There is also the critical illness. Then there is accidental death and dismemberment. That is if you fall sick. If you fall sick and you are disabled, or you have cancer, you have stroke, guess what? Your employment is going to pay you short-term disability for a certain time. When you go on long-term disability, it begins to come to the place where it's the government that takes over, and you might get only like half your salary or 60% or whatever, which might not be able to cover. So it's good to have critical illness, even if you're working. Critical illness insurance is an insurance that will pay you when you're still alive. Say you are diagnosed with cancer, you live with it for 30 days. If you bought 100,000, they cut you the check for 100,000. So you take it. You can go treat yourself. Maybe you want to go treat yourself in India or some other place, you can use that. That is the good part of critical illness. And the premiums are really, really low. So that's another good thing that you can do for yourself. And accidental death or dismemberment is when you are in an accident, where you lose a part of your body. It's that simple, just as the word with that. Another thing that I'm going to talk about, we're running out of time, I'm just running so that if people have questions, I can take them. So another thing that I want to talk about in world is, where are you investing? So where are you investing? And I'm going to talk about 3 forms of investment: GIC and bonds. That's where when you open an account in the bank, tax-free savings account, as they say, they're putting your money in a GIC. GIC is guaranteed investment certificates. And bonds, every one of us understand what bonds are. Like you say, treasury bonds back home and all of those bonds, government bonds that you can buy. Now, in this form, if you invest in GIC and bonds, you're sacrificing growth for safety. Excuse me. What I mean by that is that the growth is slow. And these are for low-risk people. People who don't want to take any risk, because you lock in the money in a GIC, things like those LIRA, RESPs, RRSPs, tax-free savings account. If you lock it in a GIC, it means that the bank has accepted to pay you maybe 0.5% or 1%. Some of them can go highest. I think highest I've seen is 2% or 2.5%. That's really the highest they could go. And if you lock in there, so it doesn't matter whether the market goes to 20% or it goes up how. You're locked in for maybe 5 years. After 5 years, you can go and renew. So that's why we say you sacrifice growth for safety, because you don't want to take any risk. In those ones, if we had internet, I will show you the compound effect, and you will see how the compounding and the growth is very slow. So that's why you're sacrificing the growth for safety. The second form is mutual funds. Mutual funds too are being done by the banks. And mutual funds, you sacrifice safety for growth. You see, the other one was sacrificing growth for safety. But mutual funds, you sacrifice safety for growth. So you are a risk bearer, and you don't care whether the market goes up or down. You lock in the money in mutual funds to do that at banks. And so whether the market goes up or it comes down, you don't really care. So you invest it into mutual funds. And if the market goes down, you lose. Many people have accounts with that. I've seen so many customers with that. Tons of them, many people in mutual funds. And so you would make profit when the market is going up, and you would lose when the market is also going down. So, and there is no guarantee there. The last one is segregated funds. Segregated funds is a combination of safety and growth. Combination of safety and growth. Why is it safe for segregated funds? It's because they have a guarantee. So they have an insurance that covers segregated funds. That's just the difference between mutual funds and segregated funds. It means that if you invest 10,000 in it, they can guarantee you that if the market goes crazy or something happens, that the market crashes, you're guaranteed maybe 75% of the money. And if you want to go for a guarantee for 100% of your money that you invested, you will just pay a little bit higher, the maximum 75% of your money. And there's always the ratio of 75-100. If you go 75-100, it means that 100%, if you pass away, the banks will give you 100% of every money if the market was down. That's only if the market is down or if the market crashes. But if at the time, let's say something happens, or you pass away, and you have put 10,000 and it's at 15,000, you get your 15,000. So that's why they say it's a combination of safety and good, because the safety part comes from the fact that it has an assurance insurance on it. They insure a part of the money that you are guaranteed this amount if something happens. So these are the things that are good to know when you are doing your investment. These are the places where you want to invest your money. And you know that mutual funds and segregated funds, they would give you high interest, more than GIC and bonds. So many people lock in. I myself, I've been a victim when I worked with the bank. I put my money in GIC. And so you never get really anything. You put money there, after some years you come, the interest is $50 that you made. So that's why you see all of that. But when you put mutual funds or you put the seg funds, then that's when you begin to see sometimes you could get 10%, 12%, depending on the market condition. And with seg funds, depending on who you invest with, you can actually reset. It means that you reset. If I go put 10,000 today, I see the money is at 12,000, I hit reset. The 12,000 becomes my capital, not only profit. That's another thing that you could do with your money. You reset it. You hit a reset, even though you're locked in, but you can reset. And the last thing that I will discuss before I close and take questions, if there are any questions. Child tax benefit. Child tax benefits. Are you saving your child tax benefit or are you eating it? You know, it's amazing. I have spoken to many families that they think that the money that the government is giving you for child tax is money for you to eat and take and buy food for the kids. No. If you are getting money as child tax benefit for your child, make sure that at least 50% of that money is invested. I know of couples that get about $3,000 a month because they have 3 or 4 kids, that they receive that amount of money. If you're getting, let's say you're getting $1,000, let's just be real. I know a couple that gets about $1,000 or more for two kids. Government is giving you that, and if you're using that $1,000 for food, paying rent, and all of that, you're not doing your child any good. You are not. Because if you're getting $1,000 for 2 kids, you should be investing at least $600. At least $600. You can take the $600, you put $200 in RESPs. And then you go do other form of investment. You can put it in a universal life, where you also maximize profit there. $100, or you put $50 in a universal life, and it gains more profit for the child. That is where they can take money and do their down payment or other things. But you want to make sure that you're taking advantage of the RESPs and you are investing for those kids. Because for kids, you can't open tax-free savings accounts for them. And so you only have 2 forms. You can put RESPs, or you can get them a universal life policy that has a surrender value and get that going. Now, another thing that you want to know is, and I really, really insist because I have talked to so many families that are saving very little or nothing from the child tax benefit. If you're doing that, please do not do it. Stop doing it. You are sacrificing your child's future for them to go take OSAP tomorrow. Whereas if you were putting that money in an RESP and maybe investing some in a UL, you will not have to pay fees for them tomorrow. They can go when they reach 18, they take money from those RESPs and supposed to take care of themselves with their education. Like they had money in their UL, they have a cash surrender value, they can take that and do their wedding. They can go there, take that and do their wedding. They take a cash surrender value from it, or they take a line of credit and put the bank as a beneficiary on it. They do their wedding, or they do their down payment from home. You don't need to spend for them. This is how you invest for your children. This is why you see a lot of people, especially of other races, they don't struggle with their children because they know how to invest. They know how to invest for the future of their children. So if you are that person that is using your child tax benefit for food, groceries, buying them clothes, you are not doing good for your kids. Now, another thing that people do, a lot of people that I speak to, they do is that they trade stocks. They trade Forex and crypto. One thing I just want to rush through that is that if you are trading stocks, doing Forex or you're doing crypto, make sure the money that you're putting there is money that you are ready to lose. It's money that you're ready to lose. Don't you dare. I've spoken to a lot of people. I have a friend that lost $100,000 from crypto. I'm telling you, they took equity from the house and put it on a crypto, and it just goes. And I remember one of my friends that spoke to me about it, and I'm like, It doesn't, because I have learned my lesson from it too. I learned it the hard way. So don't think that I am holier than thou or something. No, I learned it the hard way. I have been a victim. So that's how I learned it. So now many times when people come to say, well, we have something about finance or something that you can invest money and get more, I like to go and listen. Because me, I'm one of those people that got Thomas. I'll just go and sit there and listen, and then I start asking questions. So if you are investing in stocks and you're investing in Forex, if you don't know what that means, is foreign exchange, that you trade currencies, or crypto, please only put money that you're ready to lose. It's not that you cannot make money from there, but it is that volatile. You can easily lose everything. I'm telling you from experience, you could lose everything. So don't take your investment. Don't take money that from your RSP or your tax-free savings account and put it there. No. That's like you're going crazy. Just put the money in it that if that money is lost, you will not cry. Don't go borrow money or take your line of credit and put it in it. Never you do that. That's it. If you have more questions about that, you can ask me. You can ask me. There's so many places that you could trade stocks. You can trade it with your bank. You can trade it yourself, work simple, other forms of trading. But you have to have the expertise. Then nobody just say, open the account, buy this, and you go, no. Be informed. Educate yourself before you get into any of those things. And if you have questions about that, always ask me. Because I make sure I educate myself on finances. Because I have made up my mind that I will not be broke. I will never be poor. And so I get myself well educated. Now the next thing I'm talking about is wills and estate. People think that getting a will is a bad thing. No, make sure you get a will. Make sure you get a will. It might cost you a little bit, but make sure you get a will, especially if you have a little things, some things that you want to leave to your this or that, or you have a life insurance, make sure you get a will. If you have a life insurance, you must have a beneficiary. That was another thing that I'll talk about. So because if you don't have a will, it is very complicated. I happen to have worked for the bank and worked in the estate department. So I know what I'm talking about. There is so much trouble when somebody dies without a will. And then the people that are surviving who wants to have access to know how much is in that account or this, the banks will not talk to you if there is no will showing who is the estate administrator. There is so much confusion. And so you guys have to shut down everything and first go and apply for estate administration. If that, sometimes you're doing that out of your pocket and you come and discover that the person has left only debts. There is nothing, but nobody will tell you until you get that you are an estate administrator. Why? Just make it easy. Go get a will. Go get a will. If you want to know how to get a will, you can also reach out to me. I'll tell you. There are some platforms that you can actually get a will package for free. It's pre-made, and you fill it up and just get a lawyer to notarize that. Estates, it's very good to plan your estate. And that is done in the will. You plan your estate. Oh, if I die, bury me here or do this. Some people think that is a bad thing. No, it is not. If you see the confusion that happens when people pass away, then you would want to wake up from your deathbed and come and give instructions before you go. No, always do it. Always do it. Put it into writing and say, this is what I want, this is what I desire, and all of that. Sometimes, if possible, get it notarized, and the lawyer keeps a copy. And you save your family from headache. A lot of headache, because it's going to cost them. The money that you're deferring to spend now, you will spend double or even triple. When you die, your family will go and spend just to get that administration of the estate. Sometimes it's some money that is locked in, like your RSPs, or maybe the work insurance and all of those things. Nobody would get it until they get that paper as an estate administrator. And sometimes going through the court to get that probate for the will or for the estate to be probated, it could take up to 6 months. But if you had that will, they just pull that piece of paper, and we're gone. And everything begins to move. So it makes life really, really easy. It makes life really, really easy. It's very important that we get it. Sometimes we think that, oh, why would I sit there and be saying, if I die, this. No. It's very important. Next thing I want to talk about is beneficiaries. For everything that you do, even at your workplace or work group insurance and all of that, make sure you have beneficiaries on it. Because if you do not put beneficiaries on your insurance premium or insurance coverage, if you don't put a beneficiary, what happens is that when you pass away, that money, the insurance will cash it out. They will send it, whoever is representing your estate, they will put it into your estate. Now they open an estate account. If you had a credit card debt, if you had this, they will pay all the debts, and then the rest can go to the person that is appointed as the estate administrator. But if you have a beneficiary, nobody can come there. If you're owing this, the money goes to the beneficiary. No questions asked. So it is very important that you have beneficiaries for every investment that you have, even a tax-free savings account, everything. Have beneficiaries. Once you pass away, something happens, that money is going to them. It doesn't matter whether you owe the bank 100,000 or this. The bank cannot come. It cannot attract the banks on it. But if you do not have, what will happen? They'll open an estate account at the bank, and then they pay the banks. If anything is left, and then it goes to your estate. And then now the estate administrator can go in and touch it. Last thing, taxes. And many of us pay a lot of taxes. I'm not even going to labor on this a lot because many people pay taxes and you do not know, or you don't know how to handle your taxes and all of that. It's good to have somebody to help you with your taxes. But one of the ways that you can manage your taxes is that if you are working, it's also advantageous for you to always get something. You can get a business. When you get your business, then you have a business number, or you have your business that you can file your taxes by yourself, then you can write off a lot of things under taxes. You see, your gas, those things that you spend daily, expenditures, you can write them off under taxes. If you have a side hustle, if you have a business that you're doing, that's another good thing. When you are working, remember or try that you get something, a business that can help you. Because when you get that, then there's a lot of things that you can write off on taxes. That, if you need more advice on that as well, you can always ask and you get advice based on that. So this is what I prepared for each and every one of us for today, just to give us those point forms, little things to know about finances. So if anybody, I've come to the end of my presentation for today.